So today I'm pleased to be joined by Brett Friedman of Winhall. We had him on a little while ago, and we're going to talk a little bit about volatility, risk, and what the market is doing now today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mike, and welcome, Brett Friedman. Great to have you back, my friend.
Thank you for having me.
So, you had circulated a couple ideas that you had about what's going on in the marketplace. The first thing that occurred to me, there was a book about options trading that was written by a guy named Chris Cottle a number of years ago. I think this book probably dates to maybe the early 1990s. But the name of the book was Perception and Deception. And when I saw the piece that you put together, that was the first thing that occurred to me. What is people's perception of risk and volatility in the market and how things are doing versus what is the reality of how risky the market is compared to its own history? Why don't you tell us a little bit about what you're thinking there?
I wrote the piece for the OptionMetrics blog, and the reason I wrote it was because I keep on reading in various financial publications or just mainstream media about how volatile the markets are, and that they're subject to wild swings, and that's one of the reasons people are moving out of equity or they're moving shifting sectors in equity. And my initial impression was my usual idea that when people talk about volatility, options traders don't think the way they do. The options traders have a very specific way of looking at volatility, and they don't use the term as loosely as I think the press does. But regardless, I decided to look into whether we are indeed more volatile now. And the way I define now was 2025 and year to date than in the past. And so I looked at all the data since 1996. And I looked at the two things or several things. I looked at the VIX and I looked at the SPX. And I was concerned about, I mean, VIX jumps, which usually indicates, high degrees of volatility when the VIX jumps up, maximum VIX numbers, and with the SPX, negative returns. What sort of negative returns are we getting? Days that the returns are greater than 3%, et cetera, like things like that, the worst 5-day return. And sure enough, I have some data on this if you want to put on the screen. Sure enough, 2026 and 2025 have been nothing special when you look at these various factors. As a matter of fact, in the VIX, the number of days where the VIX has changed more than 5 in absolute value for 2026 is exactly 0. The maximum it's gotten up to this year is 22, I believe 21.77. In past years, it's been over 50. Similarly with the SPX, the days where return is less than 3%, or a big down day, is just not there. It's 0. In 2025, it was 3 times. But however you look at it, if you go back to either 2020, 2008, the dot-com bubble, 2000, or basically any year, there is just nothing special about volatility in 2025 and 2026. I could probably make an argument if pressed that volatility is actually a little lower. 2025, maybe a little, however you slice it, it's a marginal difference one way or the other. There's just simply nothing special about volatility currently. And I think the reason people are talking about that things are more volatile today is that they're confusing uncertainty with volatility, the way that options traders think about it. If you put up the next slide, I can show you exactly what I'm talking about. So when you look at economic policy, trade policy uncertainty, and there's a bunch of indexes that quantify this. This is just one of them. You can see that the trade policy uncertainty is extremely high, and generally economic policy uncertainty is extremely high. And I think people, and that's undoubtedly true, and people are uncertain about the future. It seems like every week we get something new, tariffs, who knows what, entering the market. And people confuse that with day-to-day volatility in the market. And that's the what I think is the perception of volatility, but it's not the reality of volatility. If you actually do the numbers, the volatility is not higher. What is higher is trade policy uncertainty and general economic policy uncertainty, and the two should never be confused.
So, right before we came on, we were talking about something that I think is something that volatility traders think a lot about. It's not a term that gets used a whole lot. I could be wrong. I mean, I watch Bloomberg TV, I watch CNBC, I watch, sometimes Yahoo Finance, because some of the folks from CNBC have gone over there that I know. I don't hear people talk about dispersion very often outside of options land. For those who are watching us now, or whenever you happen to watch this video, and you're saying, well, what is dispersion? What's he talking about now? What I'm talking about is the relationship of, if we're looking at a universe of securities, let's say, is the relationship of the price in one to the price action in another. So things like pairwise correlation, and also, for the group and relative to the price of options on that group. So this is a really common trade for options traders to engage in. It's actually the trade that I did for probably 3 of the first 5 years that I traded options was trading dispersion. What that meant was that I would primarily sell options on an index proxy or the index itself, and buy options on single stock constituents of that index or names that we perceive to be closely correlated to it. And the way that a volatility trader makes money in an environment like that is that or at least in that trade, so you could theoretically do the trade the other way around, so I could be short options on single stock and long on index. But functionally, if you are long options on single stocks and you are short the index options, then you're making a bet on the correlation of the underlying basket of stocks. And that is that if the underlying basket returns are very disperse, hence the name, so some are going up, some are going down, some are going sideways, then the index may not be doing very much, so you're making money on the short side of your index options position, but you're still making money on your long options position, your long volatility position in the underlying constituent stocks. So I'm wondering what your thoughts are, whether the perception of volatility is actually being conflated with dispersion. And specifically what I was thinking is, what's been the most crowded? What's the biggest trade? The biggest trade is tech, right? So if you could just imagine everybody was in XLK, that's a really big crowded trade, and people are really into AI. But under the surface of the information technology sector, there has indeed been a pretty profound divergence in returns that began in the beginning of July. And that was that hardware stocks continued to do well. So they basically, hardware and software, had almost identical performance. So I'm talking now about the industry groups within the S&P. They had virtually identical performance from December 31st of 2024 through June 30th of 2025. They were within 50 basis points of each other, those two. From June 30th of 2025 until December of 2025, They diverged by 17.5%. And as wild as that move was, they diverged by more than another 20 since then to today. I think you and I were just talking about it. NVIDIA and Microsoft, for example, since June 30th of 2025, their performance is more than 40% different. And these are as you pointed out, two $4 trillion companies. So a 40% divergence is a $1.6 trillion divergence in performance in the appreciation of NVIDIA versus Microsoft. Do you think that and this goes where I was talking about before, the perception versus deception, that people's volatility perception is actually coming not from market volatility, not from index volatility, but instead from dispersion?
Partially, because not only you didn't mention one thing, because we do indeed have a lot of dispersion going on within the tech sector between software and hardware, but we also have some more general dispersion going on between, like, like take energy XLE is up, I think, about 21% this year. And then you take financials and they're down about 7.75, something like that, year to date. And there's all the different sectors are diverging as well. Uh, so you also have that going on. So you have the dispersion within tech, and then you have a general dispersion going on in the more general sectors, both of which are are leading to, diversification is in play here. So between the two of them, they're sort of canceling out, which is keeping VIX under control. Uh, and I think you're right in that the underneath the surface, I think there's a decent amount of volatility, but when you add it all up and you gross it up into the VIX, that's where the VIX is not showing the volatility or the general indexes that you would think.
I guess my follow-up question to that then would be, if the index itself isn't really showing realized symptoms of distress, and you see rotation out of the best performing sectors into sectors that hadn't performed so well recently. Healthcare is another sector that's done well, I think, since early December. I'm going to leave metals kind of on the side for a second. We'll think about that a little bit separately. But would you think that if the if the index writ large is basically not doing anything too extraordinary, and you see sector rotation, would you characterize that kind of market activity after the run that we've had in tech as healthy? It kind of feels like it might be.
Yeah, I do. I think any market where there's more diversification, where all of the gains aren't concentrated, where you have limited market concentration, is a healthier market than one where it's all concentrated in one sector and everyone's talking about, we've gone from sort of, is AI a bubble, to are sections of AI a bubble, and did we swallow something that just isn't true? The whole software rotation idea is coming from that, uh, which we shouldn't be too happy about as finance people, because we'll probably be the first to be put out of business by AI. But
Yeah. Well, I think technology has gone a long way towards reducing the value of those of us in finance. I think the easier you make it for people to do their own work, the less of a premium gets attached to the people who were generating the reports and the research and the strategy historically. Before it was easy to do a spreadsheet. Long before Excel and Google Sheets, and before Lotus 1-2-3, which was not a product that was out there really when I was in the working world, but I remember it. If I remember, I think Lotus a Massachusetts-based company.
Yes.
Maybe
Yeah.
someone can get into my ear and remind me. But I seem to remember that because I went to college there, and I kind of remember that was the big thing, And people would actually ask, "Do you know Lotus 123?" If you went in for an internship. Um,
You know,
that
I'm sorry.
was that.
I mean,
Go
when
ahead.
I started, we had, I remember when Lotus 123 came online, because before then, if you could imagine, a spreadsheet was a gigantic 12 by 18 piece of paper with all the little squares, and you would just calculate each square. I mean, the number of associates to do that was much higher than when you saw that, everyone thinks that they're going through something unique, but, in the late 80s, a lot of associates weren't required anymore because you had these, Lotus 123 and then later Excel to do exactly what these people were doing all day, just a lot more efficiently. So,
And then Excel introduced many of the APIs, so you didn't even need as many spreadsheet
right.
jocks out there
And now,
to work them either.
now people who are like, Excel masters, I remember, on TV, they'd have these Excel races, the world championship of Excel. Uh, if you could imagine a crazier TV watch, let me know. But and so those people are becoming obsolete now with AI that basically does an Excel spreadsheet for you. Uh, so
Do you excel at Excel? What was the name of the show?
I forgot what it was. It was a world championship of Excel where they would give people problems and then they would go solve them in the,
Hmm.
fast as they could. Uh,
Well, so as we look at this, now that we're mentioning Excel, one of the things that I think is interesting here in this, question about whether the trade can persist, two things just struck me recently that just sort of stood out. The first is the revenue expectations for Nvidia over
yeah.
the this coming year. So for their fiscal year, which ends in January of 2027, I think the expectations for their revenues are in the neighborhood 334, 335 billion bucks, something like that, which would represent about more than 50, closer to 60% year-on-year revenue growth for Nvidia. But it wasn't the 60% and it wasn't the 334 or $5 billion because I think that partially due to things like government debt, we've become anesthetized to large numbers. Like they stop meaning anything. Millions, billions, trillions, quadrillions. Who cares, right? But I like to think of things in relationship to one another because sometimes it helps offer some perspective. That's 1% of GDP. GDP for the United States for the next year is probably going to be in the neighborhood of $33.5 trillion. 335 billion is 1% of that number. 1% of all of the economic activity in the country next year, Wall Street is expecting to be Nvidia. That struck me as a pretty profound number. And there was something else, which is when I looked at Microsoft, a big part of the justification for the performance and the margins and the general assumption that maybe equity valuations had been far too cheap for far too long. So there was a chart that I saw. You know what? Maybe I can find this and we'll look at it together because I was just looking at this thing yesterday, and it was the Buffett indicator.
Oh yeah.
So the Buffett indicator, as a reminder for anybody who's interested, this is just the U.S. It is the U.S. equity market in toto divided by U.S. GDP. And again, this has currentmarketvaluation.com on it. I don't know the people that do this website, although I like your work. So if any of you end up watching this thing, you want to reach out to me. I like your website. I like the stuff that you're doing on it. This goes back quite some time. This is 75 years worth of data. A couple things about it that probably deserve to be, noted. One is that it's not a metric the way metrics that you and I are used to thinking about things work. Because, when we look at something like a PE ratio, a forward one, the last 12 months, cyclically adjusted, in general, we can look at metrics and we can kind of apply them to each other at various points in time. That is to say that I can say what were 10-year rates in 1968 and what was the corporate earnings yield in 1968 and what was the anticipated growth in 1968. And then I can take those types of numbers and relate them to today. The Buffett indicator turns out not to work very well in this respect, and I will illustrate this right now if I can find my cursor, which is around here somewhere, I think. Where is it? There it is. So you'll notice that instead, the Buffett indicator actually has a trend. So if we look at it in 1950, the beginning of that trend, and basically where the S&P was at the, or not the S&P, but the U.S. equity markets were relative to GDP, it looks like, from this chart, I'm going to say, it looks like it's probably 40% of U.S. GDP. And then through all of this noise, there's a trend where that number has just been growing steadily through time. And some of that growth is justifiable. I think more of the U.S. economy is sort of commanded by publicly traded companies, and so I expect to see some of that. Some of the justification for it more recently has been that as the economy has matured from sort of old world industrial, old economy types of businesses to asset light businesses that were largely intellectual property, software, things like this, the margins expanded, and that you could justify higher valuations on the basis of this new economy model. That is that, you had companies that were immensely profitable, like a Meta, for example, or a Microsoft, where they would have some investment in creating product, but not the same kind of investment that old world businesses needed. And therefore, they were going to have much higher margins and faster rates of growth. And then there was also the platform issue that once you had people on the platform, you kind of owned your whole space. My question for you is, number one, do you subscribe to that? And secondly, when I was looking at, let's see if I can pull this up too. Let's pull up Microsoft really quickly. When I was looking at CapEx, I was thinking what was once true for this company, I don't know that it is still true. So if I look at 2023, for example, I'll just circle that number. The company had $28 billion in CapEx. Big number, to be sure, but nothing compared to what that number is expected to be 5 years later. So 5 years later, their anticipated CapEx is nearly 143 billion, up from 28. So more than a threefold increase. And I look at that and I start to say to myself, is this a new economy asset light business? When you're throwing that much money at hardware that ages out, I don't know. Doesn't feel like it. What are your thoughts?
I wrote about, if you go back to the Buffett index,
I will.
I wrote about that a couple months ago, I think, because I noticed it. And I was looking at it more from the level of the market caps of the various AI companies. That,
Mm-hmm.
a $4 trillion market cap for NVIDIA, or roughly, give or take a couple hundred billion, is bigger than the GDP, I believe, of France, or many European countries. That's an astounding number. That we have companies here that are bigger than than the GDP of most countries in the world. It's just an astounding number. It's sort of like when I was writing about European defense stocks, that I found out that the US's defense spending is higher than the next 10 countries combined. Combined. That's how much we spend on defense. So when people say we don't have enough money, in the Defense Department, it's like, seriously? Uh, but the
Well, they're just comparing it to how much we spend on
I mean,
interest.
it's an amazing number. But when you do these sort of big number, when you put them in context versus things that that you like the GDP of many countries, you realize how gigantic these numbers are. The Buffett index is interesting, but it's interesting. I'm not totally sure what to do with it because, like it peaks out in certain times. It goes over one standard deviation. But if you were to follow this religiously, you'd miss some fairly significant bull markets that have taken place. Markets just don't turn. They can be overvalued. I mean, I always tell everybody, markets can be overvalued for a long time, you know, until they finally come off. And all the indicators can tell you that the markets are overvalued, but yet it keeps on going. And that's where how much return do you want to leave on the table for, every time you see an overvalued index, are you going to start selling off your portfolio or are you
it's
getting
a
defensive?
it's a great point you make, and as soon as you said it, something occurred to me. In 1996,
86.
Alan Greenspan was
Yes.
was talking about irrational exuberance, and one of the models that the Fed uses to evaluate the expensiveness of equities is to look at the earnings yield of the S&P relative to the 10-year. And, by that model, if you used that model, if you adhered to it, you might say, okay, well, in 95 and 96, this gap was that the 10-year Treasury rate was higher than the S&P earnings yield. And you can see there are some periods here where it was substantially lower. So, for example, and when it was lower, by the way, for what it's worth, those generally proved to be pretty good times to take a bullish position with a long-term view because they often adhered to, profound, bear market regimes. But 1996 would not have been a great time if you were listening to the Fed and listening to Alan Greenspan to dump your stocks because for another 3.5 years after he gave that speech, there were hiccups along the way, to be sure. We had the long-term capital management debacle, we had the Russian default, and we had the collapse of the Asian tigers was in the midst of all of that. But despite all of those things, U.S. equities did well, and the best and fastest growing portions of the equity market did much, much better. So the NASDAQ, which a lot of people might have said was overpriced in 96, didn't top out until March of 2000, almost 4 years later. And boy, that would have been an awfully painful exercise to watch all of that from the sidelines. Where were you working at that time, by the way?
In
So
96,
96 to 2000.
I was trading power for a power marketer, but I remember the anything with .com at the end of it, you could get money and become, and almost generational money if you had some sort of crazy .com idea, most of which were just sheer, fantasies. But, I had friends that became extremely wealthy on basically nothing, which always, whenever I think about it, I remind myself of what Gore Vidal once said, that every time one of my friends succeeds, a small part of me dies inside.
um, I you know I had have a good friend named also Brett. As it happens, he made his first $1,000,000 in a single day during the tech bubble by accident.
Well,
By
you know,
accident.
they, they
So
take
the
money
thing
anyway.
was, and you'll remember this, and you'll appreciate what I'm talking about. Is that anything, as you pointed out, anything tech related, anything with a .com at the end of its name, or somehow connected to that whole trade, like the new modern economy. When these companies were to IPO, um, getting an allocation to the IPO was a really big deal, because all of these things would go up many times, on the first day of trading. And so I won't share anything else about the individual I'm talking about, but he was, if my memory serves, he was a client of Morgan Stanley. And he was given he was also an investment banker at a competing investment bank, but whatever. He had an account there, and he managed to get an allocation to an IPO. And the way the allocation was transmitted was 100.00 shares. But they somehow missed the point.
It was 10,000.
So when he woke up the next morning, he didn't have 100 shares of this IPO in his account. He had 10,000 shares of the IPO in the account. And the shares were up something like $130. Didn't even have the funds yet in the account to cover the buy.
Well,
hit the sell button and booked a 7-figure profit on a clerical error that somebody allowed him to purchase more of the stock than he was. And I was thinking to myself, they couldn't have over allocated. I mean, I guess that you'd have to exercise your green shoe option. What are you going to do if you had over? Because you would kind of think to yourself, well, if you made that mistake in one case, wouldn't you have made it in more than one? I don't know, but that was the kind of era we were in. It was just stupid. People would make silly amounts of money in no time at all, and over something as crazy as that. Now, no part of me died inside when that happened. He was one of these people. I was very happy to see him make a bit of money, and his way of celebrating was to take everybody to. He got a suite at one of the Las Vegas hotels. We were all living in New York at the time, and we all went out there. And we had a great time.
the question I would have for you now is whether are the AI hardware manufacturers, are they as overvalued as some of the crazy .coms in the late 90s, or do they attract the same fervor as then? My opinion, having lived through both, the answer is no. This feels like a much more orderly market than that was. That was just based on nothing. At least this is based on some financial numbers. You might think that the financial numbers are too big, but that was, lots of companies back then were basically, they had no finances because they didn't have any sales. All they had were costs.
Yeah, those companies were vapor,
Right,
in many
vaporware,
cases.
the whole vaporware. But
And
similarly,
and
you know, we've lived through, or if you were several hundred years old, I guess, you've lived through several. I mean, the South Sea bubble had very similar things. The railroad bubble, uh, you know, uh, automobiles, electricity,
tulip
all
bulbs,
of these things have had
the
early
Nifty
days.
50.
And automobiles, there were over 200 car manufacturers, I believe, in the early part of the 20th century. And they all shook themselves out eventually, and only a few survived. Is that what's going to happen in AI? Frankly, I don't know. Uh,
Well, we have a couple behemoths. That's one of the distinctions I would make. I would say that, and I have said publicly on more than one occasion over the course of the last 3 years, as NVIDIA became the most valuable company, that I said that it was valuable, but it was not overvalued. And the reason I said that was because they were generating such extraordinary growth, such extraordinary free cash flow, and such extraordinary net income. I don't remember in my professional life seeing companies with 55% net income margins after taxes. I don't, at scale. It's very difficult to compute how you have a business that at a gross profit level, 75 cents of every dollar of revenues is profit. What? That's, it's just amazing. Um, the issue that I have is not so that's it's definitely not a parallel with the tech bubble to your point when we compare that because there was nothing like that to your as you were indicating a lot of these companies they did not forget about profits they didn't have revenues they were nothing it was just an idea. Nvidia is not an idea. They have the most popular product on earth right now, and I don't know that we've seen something come very close to this in the past, but it is hardware, and hardware changes. It evolves. Technology evolves. Quantum, if quantum's going to be a thing, how far off is it? Is it a 2029, 2030 thing? Is it a 2035, a 2040 thing? And how much does that change the landscape? Um, I was attending a conference about 14, 15 months ago in Miami at Crossroads. I think it was called the Crossroads Summit. Um, and they, had a lot of people who were, talking about exactly this issue. And some people were saying, "Oh, we think quantum might be on scene in 2030. Like that's our earliest estimation of when it might take place." And they also made another point that some existing technology, hardware technology, is necessary for quantum machines to work. So just because IBM's quantum machine turns out to be a vast success, they iterate and it becomes something that has real utility, it still needs some existing hardware to function as well. So that doesn't preclude it. But it does beg the question, will we be talking about Blackwells and the other successor NVIDIA GPUs that basically are all the rage now then? And the answer is, well, certainly not. Even in NVIDIA's case, we won't be because they're continuously iterating and evolving. But it's hard for me to imagine that over the course of 5 to 10 years, they're going to continue to own this space exclusively because the parallel I do see with the tech bubble is that that company then was Cisco.
Yeah.
Cisco was the story was internet and the Internet of Things, and all of it, the narrative was that none of it works without Cisco. So all of these other businesses were going to be leveraging their hardware as the internet grew. And first of all, Cisco is a larger company than it was then, at least in market capitalization. Finally, I think I'm actually going to take a look because I think it took something like 20 years or more. It was some crazy, crazy number for it to regain the level from whence it had come. So let's just pull this up on a chart so we can look at it together because you'll remember this, and you may remember it even better than I. So we'll go back to 2019 and see what this looks like.
Jesus.
If this will, oops, I put 2019. I meant to put, shows you 1999. There you go. So we're going to just draw a line here. That was the tech bubble peak. And finally, it hit and then crossed this year. 26 years later. 26 years for the guy that bought to finally say, I got my money back. But of course, you didn't get your money back because I hate to tell you, but $80 today is not what $80 was in March of 2000. So in dollar adjusted terms, you're still not back to even. But that's the common thing that I see today. I don't know. And Cisco continues to exist. It's a profitable company. It's an important company. But it's not as important as it was then. And it's not as important as people thought it was going to be. Thoughts?
The one of the underlying tenets of this whole thing is that the technology advances, but it's selective in that thought. Like, let me just give you a thought exercise. One of the big things about data centers is that they're incredibly power hungry. So you have all of these like tech people buying up small nukes and things like that, and small CCGTs to power these places because they're so incredibly power hungry. And you have local utilities and grids that are getting incredibly stressed because of it. And so that's one of the reasons why energy and all the constellations, et cetera, are so incredibly bid. What happens if somebody figures out a chip that doesn't require that much power? Are we going to have a massive amount of stranded assets and generation just lying around? Are these going to be sort of like, yeah, we thought of that. I remember that from the early stages, but then we figured out how not to use so much power, or we got power from something that's considerably cheaper, or we just figured out something else, because it seems like that's one of the big constraints on the growth of this stuff is the power generation angle. And if that's relieved, then you have an awful lot of sector investments that are going to be completely underwater as a result. So look, go back. I have a thought exercise for you. Go back 5 years and see if you could predict what is happening right now. And then just keep on doing that, going back all the way back. Every 5 years, try to predict the next 5 years, even if you know what it is. And you won't be able to do it. The pace of technology, you just can't predict it all that well. The most you can do is just say, look, it's sort of like gold and silver. I mean, I knew that gold and silver when it, was completely insane the way it was acting, but are you ready to start going short this stuff? This stuff's going straight up. You'd be standing in front of a freight train. Whatever reason the stuff is going up, it's going up. And my job is to make money. It's not to be right. So
Yeah, I mean, or you have to be extremely patient, like Peter Schiff.
have it
You have
have
to
it yeah.
have to spend a whole life devoted to the idea that monetary debasement is eventually going to
Everything where
cause gold to take off.
everyone's eventually right. Uh,
Yes,
as a risk
even a broken clock's right twice a
as
day.
a risk manager, my job used to be to play the heavy and go talk to traders that are underwater. And when is this idea going to work? And sometimes I would have to say, there's something going on in this market, honestly, that you don't understand, or your timing is off, or whatever. But this is just not a great use of capital right now. We can make a lot more money, a lot easier in other sectors than waiting around for this thing that's going to happen that might not happen. So I never bought eventually it's going to work. Uh, you know, that's eventually the Messiah is going to come. We're going to wait around. So,
um, yeah, it is interesting that that you mention. Oh, we did get. Oh, look at this. So somebody made a comment. So we normally have a live stream chat, and I've been advised by our crack producer that the live stream chat, there's something broken with YouTube live stream chat. So for those of you who are watching who are trying to send us messages, I apologize. It's as far as we know, it's them, not us. But we did get one message, and apparently Nvidia earnings are
yeah.
out. 62.3 billion in revenues. Wait a minute.
What was it?
I thought that number was supposed to be closer to 66. No? Am I crazy? No. It can't be that far off, could it? No. Though the stock is. We have an upbeat sales forecast. I must have that wrong. I had that number in my head for some reason. I'm just going to double check. Actually, I'm not even sure I can double check because the way the terminal works. Oh, wait a minute. No. Oh, adjusted revenues. Okay. All right. Before anybody gets too freaked out. So, because I saw that, I was like, whoa. That seems way light. So the adjusted revenue number, according to Bloomberg, is 68.1, which is actually above the high end of the range. That's 62.3 billion. Anil, I don't know if you're just trying to put a scare into me. Like, I was really going to have to stop this because I was going to have to sort some things. Between our 5 funds, we have about $1.6 billion. in NVIDIA right now. So that would have mattered a little bit. So interesting. Okay. I'll have to get to the bottom of that number. It's, I mean, look, the numbers are just out. But according to Bloomberg, at least, the adjusted revenue number. So for me, that's like for like because I'm only looking at those adjusted revenue numbers. So for example, the last quarter was 57 billion, and that works out to 73% year-on-year revenue growth. 55.8% net income margin after taxes. So almost 56% after taxes, 75% gross profit margin, which is higher than the elevated margin forecast that had been predicted for the next several quarters. So what that it would not surprise me then. I mean, can you imagine that is, wow. This is, if we go back 3 years, that turns out to be, so I'm just going to give you, I want you to just, you were saying 5 years, forecast 5 years. Let's play this exercise. So exactly to your point, we now know what their full year adjusted EPS was, and we know the companies. So do you think you can, in your head, guess what their adjusted EPS was for the fiscal year 5 years ago? What do you think? What do you think it was?
I can't see. I'm sorry.
Oh well, I don't even want you to see because I don't want you to read it. I want you to just guess what you. 462 was the adjusted EPS for the fiscal year just ended. So I was going to say, if you could go back 5 years, knowing what you already know, what do you think the EPS number was?
So it would be like cents. We're
it's 20
15
cents.
cents.
20,
Yeah.
20 cents.
Yeah.
And
now
this was a company that, by the way, when that number was reported, that year represented almost 53% year-on-year revenue growth back then. So they reported in January of 2021, and they reported nearly 53% top year revenue growth. And I am quite sure many people said, and probably I said, I'm sure I did say at some point, that's phenomenal, but is it sustainable? And the quick and dirty answer is, well, we don't know if it's sustainable indefinitely, but apparently it's going to be at least sustainable up another 2,300% in adjusted EPS over the next 5 years. And that's the reason the stock's up so much, because it's one of the things that, you know what I'm reminded of, and maybe you'll remember this. It goes to your point. When's it going to be right? I was on the American Stock Exchange in the late 90s, and the Lucent crowd was near me. I didn't trade Lucent. I traded a lot of other products, but Lucent was not one of them. And Lucent, when it became its own company, a lot of people thought that this thing was going to be the technology company, because Lucent was the technology company that emerged from Bell Labs. And Bell Labs was this, it's the home of the brainiacs. If you were a scientist, engineer, worked at Bell Labs, that was, people would speak in hushed tones about you and your company. And Lucent didn't prove to be that at all. In fact, it was quite the opposite. It was a complete disaster. And I remember I would stand there and I'd watch the traders in the crowd, and quarterly earnings would come out for Lucent, and they would disappoint and the stock would sell off. And then the next quarter, I would watch the same guys, and they said, well, these guys disappointed last quarter, so surely they're not going to disappoint this time. And I watched that happen 4 sequential quarters, 4 quarters in a row, where these guys would say, the results were terrible last quarter, so they've got to be good this time. And I remember thinking, isn't this a a Vince Lombardi saying or something that winning is a habit, unfortunately, so is losing. I was like, when does their performance actually begin to tell you a little something about what's going on there? I mean, I mean,
But
where is the rule written that because they missed last quarter, they have to beat this quarter? I'm sure they'd love to. I'm sure they'd love to beat every quarter, but that's not the way the world works. It shows you there's something fundamentally wrong. And in this case, they've been demonstrating now for many years in a row that there's something fundamentally right. But I do think that law of large numbers is going to play in. So what are your thoughts on that? You'll remember those companies, I'm
I
sure.
do. But I also, I remember what one of my first trading bosses said when I said, "Why isn't this thing going down, or why isn't it going up?" And he said, "Markets are super tankers. They're not speedboats. It takes a long
Mm.
time for this thing. It can keep on going, even though the fundamentals aren't supporting it. And everyone keeps on arguing about it. But in the meantime, back at the ranch, you're losing money day to day. What are you going to do?" I remember looking right at me saying that. What are you going to do now? So
And you were a power trader.
well, I started off in
Eh,
petroleum. I started off in foreign exchange, and then I moved to petroleum. So uh,
and
I'm
and
used to.
this must have crossed over with Enron
Oh
times.
yeah, and
And
you know, Enron was an interesting company to say the least. If you knew it from up close, the way I did. Uh,
so I didn't know it from up close, but I knew of it because as a trader, we were always very fascinated by. In the late 90s, Enron was fascinating because it seemed they behaved like a tech company where trading was concerned. What I mean by that, for anybody who doesn't know, is that there were a lot of us who were in the trading world, and literally the oldest world type of trading. My first job was trading on the Philadelphia Stock Exchange, which also happens to be the oldest stock exchange in the nation. It was founded in the late
the
1700s.
flicks.
Um, we had to read the rules, and I remember one of the antiquated rules that I had to familiarize myself with when I became a member of that exchange was that the penalty for uh, showing up on the floor inebriated, which was highly frowned upon in the late 1700s, was the same penalty that you would get if you showed up with a firearm. So I just that's how old school the place was. Open outcry. At the end of the day, I was ankle deep in pieces of paper because you were writing tickets, and that was you would actually have ankle deep paper on the floor. Enron was a fascinating company to us because they took every single thing you could think of and said, "Oh, that's got to be tradable somehow." Rainy days, sunny days, hot days, cold days, power, anything you thought you might be able to trade. They were going to trade there was something with that related to the internet that I remember, and they'd set these trading floors up, and they were going to trade all this stuff. And there were legitimate trading businesses that they were engaged in because they were an energy company originally, and then they sold all the best parts of the business off to Kinder, which later became Kinder Morgan, and
They were
so
really into. They asked me if I wanted to trade weather options for them.
mm,
And I thank God I turned them down because I didn't want to be in Houston. But they would trade, and I wish I knew where I was going to have this conversation because just 2 weeks ago I cleaned up my office and I threw out an enroncredit.com mouse pad.
oh,
I know they were trading credit, or the idea was to trade credit, receive, or whatever. I don't know what the hell they were doing, but I had the mouse pad. I probably could have sold it on eBay, but the an enroncredit.com, which is a mouse pad, which just so encapsulates what that entire company was about. Uh, but the sad part about it was that they were actually decent traders. At the core of it, they were. It wasn't the trading that took them down. It was just basically fraud that took
you
them
know,
down. So
the Raptors, all of those SP off balance sheet
yeah,
SPVs that Andy Fastow,
yeah, it
who
was a complete
um,
accounting.
Andy Fastow and his wife both went to my alma mater. As it happens, they both went to Tufts, I believe.
Well, I once had lunch with
Um,
Jeff Skilling, and he was an incredibly compelling character. And the only modern uh, congruence I can get you is if you've ever heard a large hedge fund PM speak about what he has in the hedge fund when they go and try to get money from wealthy individuals or whomever, pensions. They're incredibly compelling speakers. At the end of their
Mm-hmm.
little shtick about what they think about the economy and what they think about all the different sectors, you're reaching for your wallet. You've just heard a master sales job. And Jeff Skilling, when he was talking to me, he was masterful. I mean, it was incredible. It was very, very compelling about why, basically they're going to rule the world. And at the end of lunch, I was sure of it for like 10 minutes. But still, when you're subjected to something like that, there's some people who have that skill, and he had that skill. And I could see how he could.
And they were in your business, so this is something you knew something about
Oh,
already.
yeah.
And still he was able to convince you that they had the
No, well,
mousetrap, the one and only.
yeah. I mean, it was that compelling. A good con man can put it back in the box, even though he's almost revealed, but he can still do the long con. But yeah, fascinating company, really was.
And well, some of those people went on to be exceptional traders in their own right. John Arnold,
Yeah.
obviously, he traded nat gas for Enron, and he went on and did phenomenal things. I was on. I'm not going to say I have the misfortune, but I was on the opposite side of one of his larger natural gas trades, and I didn't realize that's who I was up against until it was a little too late. And as for the hedge fund, I worked at a big hedge fund, but it was above my pay grade at the time. They never dragged me into any meetings with institutional investors. I just lurked in the back office and was given assignments, so I never got to hear the pitch. Um, but I do know that a lot of what we did at the time was based on that pitch, and I sort of knew the broad strokes of it. The broad strokes were, well, one, we're really smart guys. I think that's always the message for all of those places. So we're smart people. We have better data. And then in the case of the fund that I was working for, we take a deep dive private equity approach to fundamental investing with a very long term time horizon. And we buy the best company within an industry and we short the worst company within that same industry. So we're taking effectively only nominal equity market exposure. We're diversified for this reason. You don't have to worry about, sector this and that. Now, as it happens, the PM specifically that I worked for, he didn't believe in any of that. And so we were always sort of at odds with the rest of the team because he didn't want to do that. He felt that the most important and the best way to make money was to ride to get the big themes right. He said that the minutia that you think you know, you don't. You have to get the big parts right. If you get the big parts right and you commit money in this way, you're likely to outperform. And all that little stuff won't matter. But if you get the little stuff right but the big stuff wrong, you're dead.
Yeah.
And that proved to be, number one, it was proved to be true because that book outperformed the rest of the fund materially. So that was 20% of the portfolio of the entire fund's assets. So call it $5 billion in assets, and 20% was in that. And that 20% made more than the other 80% combined on that thesis. And my PM ended up quitting and retiring, and that was that. So
I, I,
that fund does not exist and take outside money anymore.
I must have sat through, I'd say maybe 30 hedge fund pitches in my life. And, either as a risk manager or as a consultant for people who are thinking about investing or whatever. And the pitches are very similar. That they have some sort of, they're trying to come up with an edge of something that differentiates themselves from all the other hedge funds. But they always come up with sort of like, we do a deep dive on all the industries we invest in. And I'm always willing to say, like, all right, who doesn't? Is anyone going to stand up and say, we don't really know all that much about this? We're momentum investors. The stuff's going up and that's why we buy it. And then hopefully we'll catch the top and that's that. Any questions? So,
Yeah.
you know,
It is funny that you mention this because I have one friend in the business who is exactly that way. He started as a fundamental analyst. He worked originally at DLJ, which is actually where a lot of my colleagues worked. But he became a technical analyst. He focuses on momentum. He focuses on technical analysis. And he now calls them not fundamentals. He calls them fundamentals. Because he really thinks that people delude themselves into thinking that they can look at what companies did in the past and use that as a divining rod to figure out what they're going to do in the future. Now, I actually believe that there is some truth to that, and I do it. It's actually anybody who's ever watched my live streams or anything else knows. Of course, I look at financial statements. It's the very first thing I do. You give me a ticker, I will do two things in rapid succession. I'll take a look at the chart, and then we're going to start digging into the financials. I want to see how much are they growing the top line? Are their margins expanding or contracting? Do they have free cash flow? What's the balance sheet look like? What business are they in? Is there a moat? Those are all fundamental questions. But I do focus on technicals, and it goes actually to the point you made earlier when you were talking about speaking as a risk manager to traders under, your purview and saying, you can say whatever you like about this, but you must be missing something. The market is telling you you're wrong. We don't know why. And the friend I'm talking about is a chartist named Carter Worth. He's actually on CNBC quite a bit. He has a website called Worth Charting. He's actually launching an ETF soon. But he says that he takes his cues from the price action because he's assuming, and I think this is often the case, that the price action is going to follow what the best informed investors do. And, it'll start to get weak, presumably, when people are beginning to recognize that there's a problem, and then other people are going to start catching on, and then it causes further weakness, and so on, until everybody starts saying sayonara. And then he looks for circumstances where it becomes exhausted, either on the long side or the short side. And he adheres to this so rigorously. And he looks at, I think he told me it's something like 500 or 1,000 charts every Sunday night. He sits down and he'll go through more than 500 charts, just basically going through them. And he will not have the ticker or the name of the company on them. They're all random because he wants to make sure that he's not influencing his judgments by what he knows about the business or what he knows about the management of the company, which can change, of course, or what he knows about anything else, that he's just looking to assess whether money is flowing into a security, flowing out of a security, or is likely to start flowing into or out. Decent approach, you think?
One day, if you want to have a really interesting program, I bet you other people have done it, is I'd like to debate a chartist about whether their technique is valid statistically or not. And this is coming from somebody who grew up, next to commodity chartists, or as they were known in the trading room as the high priest.
Mm-hmm.
How often have you seen this, and how often, is this just random chance, or is this, statistically valid that you've seen this and you got X result? How many times has this worked in the past? Is there any sort of track record to this thing? Or are you just remembering, a head and shoulders, that it worked this time, so it's going to work next time? But how many times has this worked, and how many times has it not worked? Are there any numbers behind this?
Well, we'll have to set that up, and maybe I can get you and Carter on at the same time. It would be an interesting conversation. I'd really enjoy that. He does not. And I think you'll see this when we do this. We'll make a point of this to have you both on. But he doesn't actually use a lot of those conventional types of things that I don't hear him talk in those types of ways. Although if you go to his website, you'll see that he has what he calls his cave drawings. Basically, sort of the core belief set upon which his work is based, and people are going to be able to evaluate it for themselves. But that'd be a very interesting conversation. I look forward to that. Unfortunately, our time for this one has now been exhausted because we've been going for a little over an hour. But I always enjoy our conversations. I'm really glad you came on today. I hope that the people who are watching right now, Winhall. So you have a website. You want to just share that with everybody?
My advisory firm is called Winhall Risk Analytics, and I write twice a week for OptionMetrics or OptionStrat.com about options and basically whatever I feel like is interesting that week. So
Yeah, so you can get more of Brett's work in those two areas. OptionMetrics, by the way, I haven't had anybody else from OptionMetrics on recently, but they're very well thought of in the options space for options data and analysis. I should probably get one of them on as well sometime soon. So for all of you, thank you for your time. Thank you for watching. Like, subscribe. Please put your questions and comments into the comment section of the description of this video. We apologize for the snafu with the live chat. Send your complaints to YouTube on that one. And we very much look forward to having you back. And I really look forward to having you back, Brett. I will speak to Carter. I think a conversation between the two of you would be really interesting.
sure. Thank you.
Look forward to it. Thanks, everybody, for watching. Take care.